We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Florian Grummes, 25 years of experience as a technical trader, investor, and independent metals and Bitcoin analyst. He's also the head of Midas Touch Consulting. Florian, thanks for joining me today. How are you?
Tom, thanks for having me. It's a pleasure. Good to see you.
Good to see you too. You know, it's been quite a while since you've been on the show. I don't think you and I have ever spoken, so it's good to reconnect. And I'd like to start by talking a little bit about one of your, let's say, more exciting calls for people. You know, I've done quite a few interviews in and around the silver situation right now, and you have set a $50 silver target, $45 to $50 silver target for late spring 2025. So why don't we start by talking about what some of the drivers involved in taking silver to that nominal high again are here?
Sure. Look, I mean, first of all, let's talk about the typical behavior of silver. I think that is very important to understand for the people because many investors are disappointed by silver's lagging price action, right? I mean, gold is doing an all-time high nearly every day. It's about nearly $3,100 this morning. 3,000. What was the high today? 85. So silver is still trading below $35. And it's lagging, but this is the typical character. It always shows up at the end of a bull run, of a rally, and also of a large bull market. Mm-hmm. So to remind investors, the first bull market that I witnessed between 2001 and 2011, in 2010, finally, silver really showed up to the party and took over the mic. For 8 months, silver prices rallied from $17 to $50. And it was suddenly only about silver. Gold also kept moving higher, but silver was really running the show back then. But it signaled also the end of this whole first bull market back then. Mm-hmm. And the same is true for any shorter period of rally, let's say a few months, maybe like the situation right now. The metals are rallying since February last year. So if silver shows up to the party, it also means be a little bit careful. You're going to see a crazy spike in the last inning of that bull run, but it also means like probably a top in the metals is around the corner, and that means that they will also take a breather or a consolidation correction. So far we haven't seen that. Silver has not really taken over the mic. It's still lagging. It's just following gold. It's not doing its own thing. We have seen a few days where it popped up 1%, 1.5%, maybe 2% even, but not really anything spectacular. It's running into a scanning triangle. All it takes now is the breakout above $35. And I think then the way is basically cleared towards $40, $45, and then also $50. And $50 is the all-time high from 1980 and also from 2011. And I think it has a certain magnetic effect, you know, like people focus on those numbers and then somehow magically the market is attracted and it pulls like crazy and the price really goes there. So that's my expectation. And we know that silver can rally 20, 30, 50% in a few weeks. Mm-hmm. So I think it's getting ready now. So that's the technical and the behavioral kind of analysis. If you look at the fundamental and macro picture, we know that last year, Shanghai Gold Exchange, 20% premium for physical silver. We know that the solar industry, heavy demand for silver. We know that many new industrial usage is demanding for silver. It's more and more moving into a critical metal for the whole EV, electric cars kind of boom. And we're seeing now since a few weeks, similar to what happened to gold since December, we're seeing huge amounts of physical silver being shipped from London, Switzerland, and other places towards America, towards New York and the COMEX. And I think it's pretty obvious that we are around, this silver spike is around the corner. And I've been saying this now for a while. I've been also reminding people to be cautious or let's say patient. throughout the last few months, but I think we're getting there now, and it probably is maybe just a few days, a few weeks away, and we're going to see that spike in silver. And it, as I just laid out, it could easily take us to 40, 45, maybe even $50.
Mm-hmm. So Florian, you mentioned this big demand of physical metal coming off of the LBMA into the COMEX. What is this bottleneck? Why is it coming onto the COMEX, and what explains the demand for this physical delivery?
It's a good question, and it's a complicated question. I think the most important takeaway is, for 50 years, the paper shenanigans in the gold market were able to do and play their games like they wanted in the end of the day. And that has changed for various reasons. The investors are now want to see their physical gold. And since the big brother gold has already done it, now silver also is basically what people are starting to question. Is the silver really there? And so the physical market, the physical gold market, thanks to the gold exchange in Shanghai a few years ago, started to step by step gain control of the price action for the gold price. And here we are now. I think there is logistical reasons. I think we know that lots of the COMEX futures contracts have taken delivery on gold in the last few months, much higher numbers than before. So that means they needed the physical metal in New York. At the same time, Trump came out saying he wants to see what gold is in Fort Knox. They're also talking about maybe backing US bond, treasury bonds in the future, maybe with gold. We know that the smart people in the Trump administration, and the same is true in Russia, the same is true in China, they all know that they need the gold to have some powerful cards in their hands when it comes to negotiating a new financial system down the road. So, and this has dramatic implications. The geopolitical landscape has changed dramatically. I think the Trump administration has understood that America cannot continue the path of the last 40 years with exporting the fiat dollar and basically enslaving the rest of the world, because the outcome is that you have hundreds of thousands of homeless people in the streets of America, while China is taking over and is basically on the way to become the most powerful nation on this planet. So that's why they changed something. And I think it's right, even though it's very complex and it's also dangerous that they make mistakes. But doing the same thing over and over again and expecting different results is the definition of insanity, as you know. So it is important that they stopped this doctrine. And I think also that Trump wants to focus all his power and energy, military, also financially, on the competition with China. So that's why he's also stopping the war with Russia and Ukraine, all these things playing into together. And now gold is playing a more and more important role in this whole financial system again. The LBMA in London, that's where all this unallocated gold has been basically in form of contracts given out, but it's apparently not there, at least not in the right form at the right place. And now it's being shipped to America to basically back the COMEX futures contracts, and maybe even part needs to go to Fort Knox, who knows. It's lots of reasons coming together at the same time. I primarily look at the price action. It's a bull market that's also always playing into it. Suddenly people want to buy more. Suddenly people are more aware of what's going on in the market, right? People wouldn't have cared about it. What you need to understand, physical market is dictating the price now, and big institutional money is starting to question whether the gold is really there. And that's something so huge we haven't seen in the last 5 decades. And that's why gold is relentlessly, nearly every day, moving higher. And it drags silver along. And now silver, as I laid out, also seasonality-wise, it's the perfect window now, I think, is showing up. And we have basically the same situation like in the gold market. And that's the reason, I guess.
Well, I mean, there's so much to pull on there, Florian. And as you rightfully point out, it's all so interrelated. And, I remember a guest on the show years ago, and he said, understanding gold and silver is a gateway to understanding the world, right? There's so many of these threads that really open up once you really try to understand this picture. But I want to go back to thinking about this, let's say, this late spring run for both gold and silver here. What are the risks? What could go wrong yet to deter that?
Well, I mean, I think the biggest risk is obviously the challenging situation for the stock market. So obviously, over the last 2.5 years, S&P 500 and most of the other stock markets in the world had a nice run. Some of them a spectacular run. Magnificent 7, Magnificent 5, Nvidia, etc., all up like crazy over the last 2.5 years. And it's naturally that they take a breather and also pull back a little bit. But as we all know, they're also extremely overvalued. And we also know that this is a bubble. And if this bubble should burst and we would find ourselves in a similar situation like in 2007, 2008, when the financial crisis started to happen, we have to assume that this could affect the precious metals prices as well, because once liquidity disappears, even though the physical market might dictate the prices, suddenly people need to sell their precious metals to cover margin calls, to just cover their daily life expenses, whatever it is. And that's been something we have seen over and over again over the last 25 years. So that's the main danger or risk that I see. Should this correction the stock market, which so far I would say is healthy and totally normal, but should this extend and get bigger and not get under control and not bring a nice bounce very soon and then maybe a good recovery into the summer, but should this remain weak, we might get into bigger troubles that could then affect other markets like the precious metals as well. Mm-hmm. I don't see any risks because I think the physical market is dictating. I think the central banks are buying. Chinese central bank came out in November, they're buying again. So that means even around $3,000, they're probably still buying. Lots of other emerging market countries, their central banks are buying. I mean, you talked about this extensively in your channel. Since the sanctions against Russia, all these other countries realize they cannot rely on the US dollar and neither on the euro. They need a diversification, and now they need to catch up. I mean, central banks have been buying gold for decades, but never so focused and in that extent like they do it right now. So I don't think that this is going away. You know? But you could have, obviously, I mean, look, the rally is huge in gold. Lots of people, paper speculators are sitting on big gains, right? I mean, profit-taking wave due to some margin calls for traders and position traders that need to cover their losses in the stock market, and they sell maybe the GLD position that they have, and then suddenly you get a profit-taking wave, and that gets bigger and bigger, and then you have stop losses, and then suddenly gold is down $300, $400, $500. That's possible anytime right now because we had this massive rise since the last 1.5 years.
Well, that's a really important point here, and something that you and I had kind of touched on in the chat before we hit record here today is this idea that with this, this increase in, let's say, market movements, that volatility becomes something that is far more prevalent at this time. So why is it that volatility is something that you're really watching, and not just watching, but expecting at this point?
Well, I mean, for a trader, volatility is great, I mean, that's where you can make really nice money on intraday moves or swing trading moves. But for the average guy, it's terrible because it's like you don't know anything anymore. It's up and down and up, and it's so fast and it's crazy. And I mean, you can lose your account very quickly if you're not careful, right? And it's not clear anymore. Then is this an uptrend? Is this a downtrend? I mean, markets can be volatile or they cannot be volatile, and you can have even a volatile bull market. It's rare, but you can have it. And I've been saying that I think that gold needs more volatility to take us towards 5,000 and maybe 10,000. It's logically happening, as I just explained. I mean, at these price levels now, $3,080-ish, lots of people sitting on nice gains, and not only the guys who hold the physical metal in their vaults, but also those that traded, maybe swing trading positions. I mean, lots of people, you can be sure, are trading it with leverage. Even those who claim about the physical metal all the time or focus on their mining stocks or run a mining project, whatever, they're all trading it with leverage too, because that's our market, right? That's our story. That's what we're doing. Mm-hmm. And if this market is trending like it is now, they're all on it. And the more people playing it, the more volatility you get. That's actually totally naturally normal. And yeah, you see like $20, $30 pullback in 5 minutes is nothing anymore, can happen anytime. And we've seen a $250 pullback in early November last year, which was still in hindsight rather mild. I mean, it as I just laid out, you could easily see a $300, $400, $500 pullback at some point. Doesn't say or doesn't mean that it has to happen tomorrow. I think the uptrend is still intact, but just be prepared for that. And at the same time, in a bear market where people get stop loss orders or margin calls, and that's what you see now in the stock market, where there was so much leverage in the stock market. You have the same situation in the other direction, right? So lots of people are underwater and then they are forced to sell, and then you have automated sells and stop loss are triggering, and that triggers another cascade of selling, et cetera, et cetera. So it's always the same in the end of the day. And that's been my main expectation actually for this year for all markets, that you're going to see much more volatility.
Mm-hmm. Sticking with this idea and this timeline of late spring, Florian, what is the impact of seasonality on the gold and silver price as well? And is that something that, in some ways you mentioned these traders that are constantly, playing with the volatility, and that's their friend. Do they, want to kind of set it and forget it, put it aside maybe for the summer and go on vacation and come back to it when they've had a break?
Well, I mean, I think the most important seasonal cycle obviously is sell in May and go away, and don't forget to come back in September, October, right? And it works 8 or 9 out of 10 years. Mm-hmm. And there's lots of studies, and I'm saying it every year basically. You don't want to hang around in the summer doldrums with a fully aggressive position portfolio. I mean, it doesn't make sense in my opinion. It's like July and August is for the family, is for enjoying the beach, it's for enjoying the summer, and that's what many people simply doing. I mean, most people are employed and they take their vacations during that time. So it's totally logic that you have less trading activity. And so you still can make money as a trader during that time frame, but more from an investor perspective, I don't think it makes sense to be fully invested in those time frames. And you should always expect that the stock market can pull back 10% in the summer easily. And it more or less is doing this every year. And the precious metals also have a certain seasonal cycle. It's been changing a little bit. We have this data for the last 56 years. And you can see that it changed over the last 15, 16 years. I would say that the Indian wedding season and the monsoon situation in India has not such a big influence anymore as it used to have. While at the same time, China and the Chinese New Year and the Chinese holidays have much more influence nowadays. And interestingly, also since the financial crisis and basically since the Fed started flooding the markets, for some reason, the last FOMC meeting of the year in mid-December is usually always a turning point for gold. And usually it's always rather weak before that turning point, and then starts its rally basically mid-December into spring of next year. So January, February, and often March have always been very strong months for gold and silver. And over the last 10, 15 years, these rallies tended to more extend into actually mid-March, April, even into mid-May, end of May. So that's what right now the pattern is that I'm mainly expecting. Again, seasonality works, let's say, in 8 or 9 out of 10 years. Sometimes you have a year where it's doing something completely different. But I think 80 to 90% is the hit rate with seasonality. And so my expectation is that gold and silver most likely will top out somewhere in the next two months. If I see silver spiking, then I would have the second signal as a confirmation here. And then I expect some form of a pullback, breather, correction. And this probably depends also on what the stock market is doing. So I think seasonality is very helpful. We know from the stock market, September often the most challenging months. And October always a very good time to get into the stock market and then take the rally into end of the year, right? And some similar cycles are very obvious in gold and silver. So I think it's very helpful. And by the way, I mean, Bitcoin also has a very clear cycle. So I think Bitcoin mid-April usually starts the rally into June. So I think it's very soon time to be very bullish on Bitcoin.
Interesting. Florian, I want to get your take and dig in a little bit more on something that you kind of just brushed over here. If we see silver really take the mic over and really accelerate to the upside, let's say we get that 45, 50-ish dollar target, is that a time that we should actually start to be more cautious and take some of those profits?
Again, a very good and important question. So I'm certainly not selling not 1 gram of silver at $50, okay? So my target obviously in this bull market is much higher. So if we talk about the gold-silver ratio, I think it's realistic to expect a ratio of 30 to 1, maybe like 1980, 15 to 1 at the top of the bull market, at the end of the bull market. So we are far away from that. The gold-silver ratio around 90 or something is, I mean, silver is completely undervalued, even if it rallies to $50. But what it would mean is that I am going to be more cautious on my trading strategies, so on my short-term trading strategies. The way I trade gold, probably I will change once I see that silver reaches 50, simply because the probability that we get a larger pullback and that trades on the long-only side are maybe not that favorable from that point onwards for a while. So, I certainly would reduce my mining stock exposure, but I will not sell any physical gold or silver for that reason. Mm-hmm. And I would assume that maybe a few weeks, cautiously, patiently waiting at the sidelines as an investor before I get back into the sector. Again, if silver rallies for the third time to $50, 1980, 2011, and maybe now this year in the next few weeks, the probability that you get a pullback from 50 to, let's say, 40, maybe 35 is still very high, given the fact that gold is rather overbought. But at the same time, it's also true that we have been conditioned over the last 25 years to always expect these huge pullbacks. And it could also be that silver just continues to run higher, right? And for that reason, I'm not selling any of my physical silver, of course. But combine the analysis that I gave you with the fact that summer is usually a little bit challenging time, gold, silver overbought after a massive rally of the last 1.5 years, maybe stock market gets a bounce. So I think it's prudent to be a little bit more cautious than once you see silver doing that spike, and maybe reduce a little bit your trading activity and not being aggressively trading that on the long side anymore.
Mm-hmm. Yeah, again, we need to separate the idea between investing and actually selling physical versus the trading side of things. That's always an important distinction to make, because it can easily get glossed over. And I appreciate that you started that by saying you're not actually selling physical ounces at that point.
Not at all. I think having physical gold and silver as an insurance in these crazy, turbulent and uncertain times, I think is more important than ever. And you might actually, even if you get a perfect timing and you even manage to, let's say, on top, if you buy the physical, you always pay a bit of a premium normally, especially, here in Germany, I pay VAT on top of the silver, right? It's 19%. So it's actually quite a big amount that you have premiums for the physical silver. But let's say I would have the perfect timing. I sell at 50 and I plan to buy back. And indeed, silver comes back to 35. And then I want to buy back. With this situation that we have right now, it could easily be that there is no physical silver available anymore, or that I don't get my hands on it. I wouldn't even risk that. So I think it's not worth trying to time this with the physical metal. In a trading position, it's something else. And we talked about this before we started the recording, right? People need to understand that you can not only should diversify yourself over different markets and different sectors, but you also need to understand that you can and should diversify yourself over different time frames. You can have a 10-year strategy with your physical metal, And at the same time, you can have a 1 or 2 year strategy with a mining stock. And at the same time, you can short the gold market maybe with a time frame of 1 or 2 days. That's 3 different things at the same time. And it doesn't destroy your whole thesis. It's just that markets are so complex and there's always opportunities. And I don't think you can just always try to explain and understand the market with a black and white kind of approach. It's like there's so many things going on. And I mean, obviously it takes experience and screen time to come to that kind of point where you can manage different time frames. And of course, the physical metal, the long-term kind of perspective is the most important and also the most easiest one. So anybody who is new to the topic, do the physical thing. You cannot do any mistake. I mean, I have not done any mistake with my physical investments, right? So the only thing in hindsight is I didn't bought enough. So, right? Because the physical metal is very nice to you. I mean, and even if it's a big down day or your timing was bad, you take it in your hands, you see this beautiful light, the heaviness, and I mean, it's clear that this is the eternity of stars speaking to you, and it's beautiful. So you don't actually have to worry at all. But again, many people doing it, right? I mean, if you have a bad timing and you buy at an intermediate top, and then 5 years it goes nowhere, people are giving up at exactly the wrong time when the next big move is coming in the metals. So you have to be able to diversify and understand and differentiate between different timeframes and different strategies.
Mm-hmm. Well, I think that is an extremely, extremely important point, and I really appreciate you explaining the nuance of really trying to understand that just because, let's say, you have a short-term short on the gold market doesn't mean that invalidates your overall thesis at the end of the day. But moving out to that longer term time frame, what do you think ends up kind of marking the end of this bull run? This is obviously difficult, let's say, for humans to think about because it is on such a longer term time frame. But like, at what point do you think kind of marks the end or the eventual top of this particular bull run? Because we know that it is going to come about at some point.
Right. I think in the end of the day, markets are mass psychological phenomena. And believe it or not, but probably in 10 years, we will talk about something else. And we might have figured out new technologies. And the precious metals bull market might be done already for a few years, and they might be in a bear market. I mean, remember, somebody in the end of the 1970s must have felt similar to what we're feeling right now, completely overwhelmed, confused with wars, with high inflation, oil embargo, Cold War, whatever, and then you got a 20-year bear market in gold since the top in 1980, right? And if you were not able to understand that the stock market was now the new trend and that the internet and computers were taking over and that you had no business being in gold for 20 years, if you didn't realize that, you actually had a hard time in the 1980s and 1990s. So that's something that you need to understand in the big picture. I have always been thinking that gold should at least reach $5,000 to $10,000. Obviously, the more money is being printed, the higher it can go. So theoretically, it could also even go to 50,000 if they really print a lot. And you heard the news out of Germany 2-3 weeks ago. They're planning, more than $500 billion to print out of thin air to buy weapons and do some infrastructure projects. And it's not only the Germans. Next time it's going to be, who knows, the Chinese or the Brazilians. Then it's going to be the South Africans, and then it's the British, and then the Americans will print again. And that's actually all over the planet, right? So we see that the global money supply M2 is already rising again. So that's actually also a factor where I think that this gloom and doom scenario for the stock market probably will not play out. I think probably the market will find a bottom at some point rather sooner than later. But in the very big picture, I would be looking, when we talk about a potential top in the gold price, of course, first of all, I would like to see much higher prices. Second, I would be looking for a gold-silver ratio much lower than today. So at least 30 to 1, maybe 15 to 1. We know in the ground it's 10 to 1. So let's say somewhere between 30 and 10 to 1, that would be the gold silver ratio. I also want to see the Dow Jones gold ratio, let's say between 1 and 5, maybe. That's also the levels that marked the last significant top in the gold price in 1980. We're still far away from that. I would also like to see massive vertical price action in gold, meaning the last time gold topped out in the very big picture in 1980, it doubled within 1 or 1.5 weeks before the top. So that's typical phenomenon also for many markets. They tend to double at the final stage. You've seen this also in Bitcoin, for example.
Kind of like these blow-off tops, right?
Right, like a really crazy blow-off top. The market is doubling within a few weeks. That's something that you would look for. I would also assume that if we get a top in the gold market, you would see spectacular yields in the bond markets. And that's actually one of my plans. So I'd love to sell my gold and collect all these bonds yielding 15 to 20%. If you have done this in 1980, you would probably not have to work anymore in the 80s and 90s because you were cashing in tremendous yields all the time. So, and that's, I think, and you see that we have a rising interest rate environment overall. Yes, central banks will probably try to bring interest rates down again, but probably the market is not willing to accept that anymore because the debt is just too huge. So that could very well be the case that at the top in the gold market, you might get 20% on your US Treasury yield. Who knows? I mean, I'm making this up right now, but that would be something I'm looking for. And you obviously would have your taxi driver telling you how much gold he now owns. You would also probably see the mainstream media having gold bars all over their front page. It would be the talk of the town, right?
You'll see the magazine covers say gold is forever now. You need to own it.
Exactly.
Kind of like inflation is dead 5 years ago.
Right. Unbelievable. It's unbelievable. That's why I said just before, mass psychological phenomena. These mass yellow press kind of newspapers are just a reflection of what the vast majority of people is focused on and seeing on and what narratives they basically talking about or believing in. And it's a beautiful reflection. And if you are able to read that and see these kind of like front page indicators, I mean, it's the best signal you get. But unfortunately, these kind of signals appear once in 10 years, you know, you have to wait a long time. So I can tell you, 2011, the significant top in gold at 1920, the German yellow press Bild Zeitung had on their front page gold bars, coins, and they basically were only, it was all about gold. And when I saw this was pretty clear in August 2011 that we are at a short-term top in the gold market. I didn't thought it would take such a long time for this correction consolidation play out, but yeah, it was a clear signal. And something like this you have to look for. And that means you have to be able to think independently, right? I mean, that's actually the most challenging part of it. So I don't have a TV, I don't watch TV, I don't care about this. I look at charts and I try to really come up with my own opinion.
Mm-hmm. Well, I think that's extremely important. And you know, I've heard you talk before about how gold bugs seem to be, let's say, have a predisposition to be far more bearish than bullish. So how do you think about trying to remain objective in that way of thinking and not just always be such a pessimist?
Yeah, I mean, you know, you can for sure easily come up with two friends, and you know that one will always tell you that this glass is half full, and the other one will always tell you it's half empty, right? Mm-hmm. It's human psychology, and some people are hardwired to that, and others are more hardwired to like being a skeptic and cautious and don't trust. And it's always difficult to walk in the middle, right? I mean, you want to be open-minded, you want to be an optimist, you want to believe in the good, but at the same time, you have to be careful. You cannot trust everybody. You cannot trust any news anymore nowadays. And you also have to be very careful if you see a stock market bubble. But as we all know and learned over the years, these stock market bubbles can go much higher than any gold bug was able to imagine. Yeah. And that's what it is, right? And I think you have to be really rational, and you need to learn to listen to the market. So that's, it's been painful lessons for myself over the last 25 years. Like whatever Mr. Grummes thinks, it actually doesn't really matter. I have to be able to listen to the market. The market is speaking, not every day maybe, but most of the time it's giving you informations. And look, gold right now. For example, how many of these young, unexperienced new investors and traders have missed this rally in gold? Probably have even made losses and have been running behind the train in recent months. And then you see gold breaking out, and what they're saying to themselves is, it's way too high now. I have to short it. It is so high now. It has to come back down. No, it's a bull market. It will kill you. You don't short this. But people do it over and over again until they learn the lesson. Mm-hmm. And with the gold bugs, being stubbornly only focused on the end of the world, I don't think helps. We have to be aware of all the problems. We have to analyze it, and we also have to make clear statements about sound money and about the problems in the system and all these kind of things. But at the same time, you still need to be able to listen to the market. And if there's a time where gold is pulling back or moving sideways, then you have to accept it. And then maybe it's not the time to being fully invested with mining stocks and leveraged gold products. Again, physical gold and silver you can always hold through multi-month pullbacks. You don't hold it through a 20-year bear market, please. But we are not there yet.
Yeah. Florian, as you mentioned that, once we get more printing all around the world, gold is going to accelerate here. That kind of brings us to the idea of, especially the dollar. How is that affecting metals right now? What do you expect to see out of the dollar, and what role does the Fed still play within the gold market as a driver?
Well, I'm more or less agnostic when it comes to the US dollar nowadays, because I think, as I mentioned before, the physical gold market has taken over, and any and all fiat currencies on this planet have the same fate and the same situation. People losing the confidence into it. And then maybe one day it's that the euro is a bit stronger, and the other day it's the Japanese yen, and the third day is the dollar. But do you really want to own those currencies? As a company and you're doing business in these currencies, yes, then you need some hedging strategies probably. But as an investor, I want to own hard assets and not these currencies. So it looks like, and I think Donald Trump also wants this. He wants to have a weaker dollar, and he's getting it right now. It seems that we had an important turning point for the dollar against mainly the euro, but obviously all the other currencies that are in the DXY index as well. It looks like we're going to get a weaker dollar over the next few weeks, months, and years. And that will be supportive for the precious metals and for all the commodities, and actually also probably for the stock market. So I don't trade the Forex. I never traded it. I don't understand why I would trade Forex. It's like one paper fiat money against the other. Where's the point? But I think you're going to see a weaker dollar overall over the next few months and years. Can we get a bounce again? Of course, anytime. It's been a nice move over the last few weeks, but this will be supportive for gold. But then again, look, what we have seen in the first bull market, 2001 to 2011, it was a much stronger correlation, and you really needed a weaker dollar back then for gold to drive higher. Nowadays, gold is just doing its own thing, and it actually doesn't really care what the dollar is doing, right? So I think that's where we are, and I think that's what gold is doing in any and all other currencies as well. So, and look at gold in Turkish lira. That's giving you the picture where it's going, because there's nothing stronger than once people are starting to lose confidence. It might seem slow for people who are in that business and are into gold and are studying it and understanding the whole situation for years and decades maybe. But for most of the people, they are busy with their little lives, having their 9-to-5 kind of work situation. They might have children and are probably happy if they can have a beer and watch some sport in the night or in the evening. they don't want to think about the financial system breaking down or gold going through the roof. They're coming late to the party, and all they want to hear is that everything's okay. Yeah? And so it takes time. Is this like this?
Mm-hmm. You had mentioned earlier as well this idea of basically the war with Russia right now, that Donald Trump seems to be, working to at least get the ceasefire, and obviously there's downstream steps from there to have happen. I've seen reports out of France that they're going to be sending troops into Ukraine. What is your perspective from Europe? I know you spend some of your time at least in Germany. So why do you think that there is, I don't know if appetite is the right word for it, but why does it seem that Europe is far more interested in escalating this conflict?
Well, it's called warmongery, so I mean, it's terrible. It's terrible. And if you study history, I mean, those same type of people are responsible for the First and the Second World War in the end of the day. And it's just stupid. And we really have to stand up and call them out, because it's just brutally stupid. And I really appreciate that Donald Trump is giving his best to create peace here. I understand that he's a challenging, difficult character to many, but again, I think if he manages to get some peace here, that will be a wonderful and great and important achievement. Because in the end of the day, it's people, it's family dads like you and I, and it's terrible, and it's never the right thing. People arrive as little screaming babies, and 40 years later, they kill each other. I mean, it's totally absurd, totally absurd. So those warmongers in Europe obviously are all driven by the globalist and left-wing kind of agenda. And they have been so aggressive in their agenda, or trying to implement this agenda, that there is no turning back anymore for them. They cannot, I mean, the only thing that would happen is if they would stand up and say, we were wrong, sorry, we made a mistake. Yeah, it would completely be a disaster. It would end all their careers. It would, I mean, none of those people has the balls to do this. Nobody.
Yeah.
So they have to continue to play their game. Mm-hmm. Obviously, the war industry is behind them. I mean, there's lots of things going on that we are not aware of. It's, again, a complex kind of thing, but it's the same thing like what I mentioned before with the trader. You have to be honest and look in the mirror at some point and realize that you made a mistake. And obviously, these people have been completely wrong. Mm-hmm. Putin and Russia would never invade Paris, Berlin, and Madrid. It's totally absurd. Totally absurd. We know that they have an issue with NATO being next to their border in Ukraine. And this is totally logical. Mm-hmm. And the US would exactly do the same if China would decide to bring their rockets into Mexico next to the US border. It would be impossible. And we have seen that in the past with the Cuba crisis. So it should be actually very obvious. But these politicians are warmongers, and they are not able to understand the needs of Russia in that sense. And I'm not defending Putin here, but I'm saying this is very obvious. And I also mentioned just before, I think also Trump has recognized the real challenge and the real competition here is China. It's not Russia. I mean, they have no chance against NATO if it would really come to a war. But it would be terrible, because it could end up in a nuclear situation, and it could basically destroy Europe. It doesn't make sense at all. So hopefully Trump will be able to really create peace here. Obviously, the whole left-wing kind of globalist people have withdrawn back to Europe now and trying to defend this part of the planet here, while they obviously have completely lost in America. I hope that this wave will take over Europe as well. The strength that the US Trump administration has shown over the last few weeks, very impressive. I mean, they have been so disruptive and so overwhelming for the opposition and the press. Hopefully this wave comes here to Europe as well. Common sense, right? I mean, again, as I just said, I mean, we arrive as little babies and 40 years later we'll kill each other. I mean, this is so absurd. You can talk, you can have different opinions, you have to negotiate, but be diplomatic and make peace and not war. I mean, this is so obvious, and it's so absurd if you believe that in the 1970s and 80s it's been actually the left wing, the Greenies, the Woodstock kind of people talking about peace, and these are the parties nowadays that demand more war, more weapons, more money to. I mean, it's crazy. It's so absurd. So I really hope that this ends soon, and I hope also that America then is able, together with Europe and also the NATO, to really focus on the competition with China in a healthy, in a positive way.
Well, I mean, I completely agree with you in all of that, and that's actually what actually kind of ends up scaring me, Florian, is because, you know, if we agree on this, clearly we're missing something, right?
Well, I mean, human psychology again. I mean, look, these people have built their careers as politicians, and they would destroy their whole career if they would be honest and withdraw and admit, like, sorry, we've been wrong. We have to move in a different direction. No, they're all driven by a hidden agenda, which comes from the lobbyists from the weapon industry. I mean, the military-industrial complex is still reigning in Europe.
Florian, I want to move to something that we haven't really touched on yet, and this is the idea of the mining stocks. Why do you think that they have lagged metals prices so much?
Yeah, another good and important question. Obviously, a lot of frustration has accumulated among mining stock investors. You had to be a really good stock picker over the last few years. I mean, if you would have bought Agnico, Calibre, Alamos Gold, you would have done exceptionally well. But if you would have bought Barrick Gold, thinking that they, as one of the largest gold producers, should be profiting tremendously of a rising gold price, yeah, you would be very disappointed. And obviously, talking about the juniors and then the smaller ones and the exploration and developers, I mean, it's really unbelievable at what levels they are trading, given that gold is above 3,000. But look, I'm trying to explain this. I mean, you know that the market is the market, and sometimes things are out of fashion for whatever reason, and they stay out of fashion, and suddenly they become fashion again. And one explanation, obviously, is that this whole gold rally is being driven by the physical demand out of China, out of the Shanghai Gold Exchange, especially. We have heard just a few weeks ago, and this is also news in the last few days, that Chinese insurance companies are now really able to buy physical gold into their portfolios. Now ask yourself, would these type of buyers also buy American and Canadian mining stocks? No. They have been buying physical gold. And you can see, if you look at some of these Chinese gold mining stocks, there are not so many, but the ones that are available, they have done actually really well. But the demand, the physical demand from China and from Asia, also from India, is not the same type of investor that would buy American, Canadian mining stocks. If you look at the GLD, which is a proxy for the Western gold demand from larger investors, right? Because many of those institutional investors are not allowed to buy physical gold. They need to buy some form of a paper certificate, like the GLD ETF. And you were seeing that actually the GLD, even though gold was rallying and making new all-time highs last year already, the GLD had outflows. And still, I mean, it's been probably bottoming out, and it's trying to move higher if you see the inflows and the inventories of the GLD, but it's still not that this gold rally is driven by the West, right? So we talked about mainstream media, optimism, all this sentiment. It's a very quiet bull market in the Western world. So this is the type of people that would buy the mining stocks, and they're still simply not there yet. I think they're coming, because now it's very obvious with gold above 3,000 that the big gold producers, for the first time probably in the last 25, 30 years, have unbelievable margins. So if you look at the all-in cost compared to the gold price now, the margins are crazy, insane, never been that good. And so that is where we are now. And I think that will step by step translate also into more and more buying from mainstream investors in the West, because they see the value. And they see that with these margins, the big gold producers simply printing money, literally. And these big gold producers, obviously, depleting their reserves and resources. And they will go out and buy all these smaller exploration development companies, especially the ones who have big projects, like multi-million ounce projects. That's what they're going to look for. And I think that will be latest than the signal, the starting signal for an insane catch-up rally in the mining stocks. Mm-hmm. So, I mean, you're going to still find unbelievable value in these smaller stocks, but of course, they haven't moved yet. And many of them are simply dormant, even though the management is doing everything they said they want to do, even though they have good drill results, even though they maybe have still enough money in the bank to run for the next 2-3 years. It's a complex topic, but I think that the sector will catch up. And I mean, what more could we ask for? Like gold above $3,000. I mean, it's obvious, and I think it will come. It's just a question of time.
Mm-hmm. Well, that's an interesting and important point that you make about the idea that central banks and, let's say, insurance companies aren't necessarily going to be the ones that are buying mining companies, but downstream from them, let's say these institutional investors or bigger funds can see the free cash flow, especially that these companies start throwing off, and that I think ends up being an attractant like a moth to a flame of this outperformance of the sector in a time when profits in many of the other things that have worked so well for the last 10-15 years is really constrained. And I think that contrast and that outperformance is very likely going to be one of the biggest things to drive, at very least, eyeballs and interest into the sector.
Yeah, I mean, if you are a value investor, you cannot ignore the gold mining stocks anymore. I think it's very obvious, and it's coming. And I mean, I've been just very recently in Zurich on a conference, and you can see that more and more mainstream type of investors and funds and institutionals showing up. They haven't been in that space at all for the last 20 years, but with these high levels of uncertainty, with obviously this strong rally, and with the fundamental data and the healthy balance sheets and these huge margins, yeah, it's obvious that they take a look now. And again, the rally feeds the rally, and all it takes is really probably one or two big M&A activities now in the sector, where maybe a big producer takes over one of those smaller companies, buyout or a bidding war, whatever, and you could quickly see a complete revaluation of the whole sector. I mean, remember 2016, it took 6 months and the whole landscape looked completely different, and stocks went up 5 to 10x in just a few months. So,
Florian, as you think about, let's say, how you trade those particular vehicles, whether it is a mining company or a developer, a junior, how do you think about taking profits? Have you developed a specific way to conceptualize when you start taking profits in some of these stocks to protect your gains that you have already accumulated on paper?
Yeah, well, look, I think it's very important to mention that your exit strategy is much more important than your entry strategy, because that's where you actually make the money. Mm-hmm. Yet, all that people care about are the entry signals, right? I mean, how many newsletter sellers are there, and you pay for a subscription and they constantly pitch you a stock here and there, but they don't call you when it's time to sell.
I remember, sorry to interrupt really quick, but I'll always remember Ronnie Stofferle saying to me that we should leave the bottom picking to the proctologists.
Yes. So, I mean, obviously, having an exit strategy is very important. Mm-hmm. And it's very difficult because in a bull market, if you sell too early, you limit yourself, right? And especially when we go to these stocks that we just talked about, the smaller ones. I mean, a junior stock can become a 10-bagger. And if you sell too early, you might be very angry with yourself. So I'm a big fan of scaling in and scaling out of these mining stocks. So that's, again, totally different. The scaling in I wouldn't do in my trading strategies, but I do it with the mining stock. So if I like a mining stock and I would say everything fits together and I would be willing to give this investment a time horizon of maybe 1, 3, 5 years, I also already plan in advance that, as we know, very volatile sector, it can easily pull back 50%, even though it seems to be super cheap already. So you need to have a liquidity reserve for that stock to be able to scale in and buy in basically multiple chunks, averaging down, which in trading is not a good strategy, but in a long-term investment, I would say it's okay. And the same I do for the exit strategy, so scaling out, multiple exits. So usually, once I have 100%, I take half off. Me basically take out what I paid for the investment, and then I have a free ride. I mean, the other 50% I didn't pay it. I took my money out, and that puts me in a wonderful situation, psychologically speaking. I'm already a winner. I cannot lose anymore. It's much easier now to let this trade ride much higher, and that's how I was able to get these 5 and 10 baggers, because I was emotionally out of it already. I had my money back, and it was a free ride, and that's how it worked well for me. So scaling in and also especially scaling out. We have a strategy that's called quad exit strategy, meaning you take 50% and then you're in a free position ideally, and you can let it run. And if you really want to take a home run, you maybe take another 25% along the way. And you're a winner. You have taken out your initial investment, and the last 25%, you can basically let it run as far as possible. And you don't really care anymore emotionally about it. So that's one of the strategies that I use for the mining stocks.
Perfect. Well, Florian, it's been a real pleasure to go through all of these different topics with you. I appreciate how thoroughly and how you think about these things very in depth. For anybody that wants to find more of Florian's work, that's all available at midastouch-consulting.com. You also have a Substack, floriangrummes.substack.com. You're on Seeking Alpha. You seem to be almost everywhere that anybody wants to read about gold, as well as on Twitter at Florian Grummes, Grummes. Florian, is there any thoughts you'd like to leave our listeners with before we wrap up here?
Well, I think the most important part of being successful in the market is really taking responsibility, and accepting your losses or your mistakes and move on. I have a diary of my trades of the last 20 years. I can go back to any trade and tell you what I did well or what I did wrong. It's not easy to have that discipline, but it helped me to really understand my own mistakes and my patterns that I needed to change over the time. And because in the end of the day, it's all about psychology. We touched on this already. There's been a lot of people on this planet the last three years that have been focusing on the glass being full or half full, and the gold bugs have been focused on the glass being half empty. In the end of the day, it's just a glass with water, and it's up to you what you make out of it. Yeah. And you need to be working on your consciousness, on your awareness, how you and your thought process actually are limiting yourself, or how you basically create opportunities for yourself. And I think the markets are a wonderful instrument to create money, to be independent and free. But you need to be really careful with yourself, because we've been conditioned over the years from our parents, from our friends, from our brothers and sisters, from the teachers, from our environment. And you have to be very careful what type of beliefs you subconsciously carry with you, and that might limit you in your success. I think the markets, and especially now, obviously, the gold market, a huge opportunity, wonderful environment. So psychology is the key.
Well said, Florian. Again, real pleasure to have this conversation with you today, and really appreciate it.
Thank you, Plum. I enjoyed it as well. Thank you.
Excellent. Take care, Florian.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.